Hi everyone, welcome to the notes for chapter 5. In this chapter we're going to cover organizational costing and profit analysis. Okay, so you all are healthcare managers, meaning that you're going to have a lot of different responsibilities, those to include planning, budgeting, and just overseeing basic operations for your facility. Okay, let's begin with slide number 3 on the difference in financial and managerial accounting. So we know that financial accounting has to do with the dollar side or the dollar amounts, the actual numbers, the numbers that you actually see. Whereas managerial is where you're making the financial decisions based off of the numbers that you see. Cost measurement, when we look at cost measurement, that is a critical part of the managerial accounting. Again, the decision making piece, because cost is everything for a facility. Okay, it is everything. Cost accounting is normally what we associate with when we talk about cost measurement. We usually, like I said, associate it with cost accounting. There's really no particular single definition for cost, and the reason being is because different costs are used for different measures, such as on slide number 6, fixed costs and variable costs. Now, if we remember from previous classes, especially economics of healthcare, you know that fixed costs are those things that, regardless of the volume, they are set. They're independent of the volume, which means that fixed cost doesn't depend on your volume to determine what a rate is going to be. If your lease on your building is $2,500 a month, that's your lease on your building. Whether you see 50 patients, 75 patients, or 100 patients every month, that is going to be your actual cost that you have to spend out for fixed costs. Some other things that are classified as fixed costs could be things like diagnostic equipment, information systems, and things and those things that kind of correlate with that. Okay? Variable costs, on the other hand, are dependent upon volume. Variable costs are those things that can change over a period of time, especially in the long run. They could actually absolutely change. So examples of variable costs, let's just say as it applies to clinical supplies, would be things like rubber gloves, tongue depressors, hypodermic needles. Even labor costs may fluctuate. How? Well, when you have part-time and full-time employees. Okay? Your salaried paid employees will be classified as a fixed cost. So those individuals that no matter how many hours they work, how many days they work, you're going to pay them a set rate. They're classified under your category for fixed. But your part-timers, the one that clocks in and clocks out, that can fluctuate because they may clock in late, losing some minutes there, the overtime. So those kind of things are classified. Those types are classified as variable. An example of a clinic in slides number 9 and 10, just so you can kind of see a breakdown based on a volume of 5,000 versus a volume of 10,000, and how some of the fixed costs and the variable cost, how they stayed the same or they changed. And as you can see, like your fixed costs, they stayed the same over a period of time. 300,000 is what your fixed costs were, whether you were seeing 5,000 or 10,000 for that particular month. Okay, is everybody with me so far? So, profit analysis. Basically, profit analysis is a technique that is used to look at an organization's cost and revenue. And based on that cost and revenue, what you actually profited. Because remember, you want to always be profitable in whatever facility that you're operating in. Okay, whatever you bring in and whatever you have going out, you want to be able to see that you're making some profit off of that. Okay, or you forecast 75,000. That, when you do those calculations, that's roughly $28.18 per visit. So basically, for each patient that comes to your facility, you're charging per visit at least $28. And that right there gives you a general idea of what variable cost rate would be for you based on those amount of patients. What is a P&L? Profit and loss statement. So when we're looking at our profits and our losses, there are going to be times where you're going to provide some services throughout the year, and it may appear as though it is a loss for you. You may invest into some equipment, and you may see that it was a loss for you. A lot of times we have to be really careful as managers the things that we spend money out for. A lot of times when we think buying a piece of equipment is going to help increase our patient load, increase our revenue, it doesn't always work like that. When you go out and buy state-of-the-art equipment, you got to make sure that you're utilizing that equipment, that it doesn't end up becoming a total loss for you. Because losses are those things, I mean, you can't do anything about them. You almost have to just suck up those dollars, and that's not something that you want to do on a regular basis. So a profit and loss statement helps you to be able to project along the way how you're looking as far as your revenue, what you got going out, what your profits are looking like. B, you got to already know what your variable fixed cost rate is. So let's say, for instance, in the example that I have, you've got $100 in revenue, and your variable cost rate is $28.18. So that gives you a contribution margin of what? $78.12. Okay? So that means that with each visit that you have, you're going to have a contribution margin, which means that each patient may revenue you so much. So like for each patient, that patient's charges for the day may be $100. Okay? But when you figure out what your variable cost rate that you already calculated per patient was $28.18, then if that patient gave if their total charge was $100 for that day, let's just say that patient's total charge was $100, where you've already figured out or projected that each patient is going to cost out at least $28.18 per visit, that means your contribution margin is like $71.82. So basically, that number can help you with how much you would have to either cover fixed costs first and then flow to cover whatever other fixed costs you have. So it's like you're charging $28.18 per person. That's what you estimate as far as the visit. So that patient's charge was $100. So you have $71.82 that can now be applied toward revenue to cover your fixed costs. You've already figured up your variable costs. You already said, well, my variable cost is going to run me about $28 or whatever per person. So when you look at variable costs, you're looking at the supplies and materials used to treat that particular patient. Whether, like I said before, a pair of gloves, a tongue depressor, whatever the case may be. Now, you've only figured up that your variable cost will be $28, but the patient's total charges was $100. So now you have a difference of $71.82. That's revenue that you brought in from that patient. Okay? And though that right there helps to go and cover whatever your fixed costs or other costs may be. Okay, so less profit is going to be a loss for you, or it's going to be a gain for you. Let's talk a little bit about capitation. So capitation, pretty much it determines how profit analysis is conducted. Capitation is usually done based on graphical analysis, where you just kind of look at graphics, you look at shifts and trends, you kind of see if you're kind of staying steady, you're not staying steady, and basically, like I said, that's usually done through graphical analysis. You're looking at two different things. One of the main things that you're looking at is the number of visits. All managers should be aware to know that your business side, your financial operating side of your business is all predicated upon your clientele. It's all predicated upon that. Because As your volume increases, revenue increases. Now, variable cost is going to increase as well, but it can change. It can change. Why? Because your volume is decreasing. So capitation is just, only thing it is it's a way to just kind of look at how you cap prices in your facility. Okay, because you know how a lot of times you cap patients. You say, oh, okay, well, we're gonna cap each patient this. You say, okay, well, I'm gonna charge, first time office visit maybe $300. A follow up patient, long time establishment with the company, that might be $100. So profit analysis is a way that you can kind of look at that. It's through capitation, where you can do it by graphical analysis. It's also a way for you to see how much utilization you're using. Okay, you know how much of your services are being used. Are you profiting? Do you have any loss? Okay, what are your financial risks? So all of that is you're able to look at when you're using capitation. Now, that pretty much kind of covers, in a nutshell, Chapter 5. I just kind of wanted to give a general overview. The book goes into a lot more detail about organizational costing and profit analysis. It goes into a lot more detail about that. It gives a lot of different types of examples. I tried to give a few in the slides. I didn't give all of them. But be sure that you do go back through your book and that you read your chapter in its entirety. Pay close attention to a lot of the examples that they gave. Pay close attention to the formulas that were given as well. Make sure you jot those down, and the examples that actually goes along with those formulas. You do have some financial problems that you're going to work for Chapter 5. You only have a few. If you run into an issue with trying to either get a problem set up, or you just have a general question about the problems, make sure you reach out to me so that I can better assist you. All right. Thank you all so much.